There are no more volatility speculative waves in the financial markets. Investors act deliberately, putting long-term market trends into perspective. Yesterday's report from the American Petroleum Institute showed that U.S. crude oil stocks dropped by 6.2 million barrels. Now, traders are awaiting official data from the U.S. Energy Department. Against this background, oil prices are supposed to rise. However, oil prices dipped as part of a technical recession. The quote fell below the 84.5 mark, with the downtrend remaining intact. Although this corrective move seems to be coming to an end, sellers still have a margin of about 1 or 2%. Interestingly, oil began to lose value even before the release of the U.S. crude oil inventory data. When the American Petroleum Institute published its report, the asset halted its slide, and most likely gloomy statistics on China's economy, the world's largest oil importer, continue to influence market sentiment. Notably, yesterday's data showed that growth in industrial production and retail sales slowed. Meanwhile, gold dropped to almost $1,900 per ounce, the mark that seemed quite an acceptable guideline a month ago. However, it has recently become apparent that even if major central banks put an end to the tightening cycles, interest rates will remain at a fairly high level for a long time to come. Now the only question is how deep the yellow metal may fall. Judging by its dynamics, gold will shortly try to break below this level. True, prior to that, the market is likely to see a slight rebound up to $1,920 per ounce. Speaking of the Russian currency, an unexpected decision of the Bank of Russia to raise the key interest rate to 12% failed to provide substantial support to the ruble. As a result, the regulator tried to calm the market, hinting at a possible mandatory norm for the sale of foreign exchange earnings, but failed. Indeed, there was no word about the foreign exchange market in the press release. Thus, the decision to hike interest rates was allegedly due to something else. This finally convinced investors that the central bank's actions are unpredictable. Unfortunately, in its efforts to support the ruble exchange rate, the Bank of Russia did everything to limit its growth potential. The dollar exchange rate against the ruble is now coming under pressure from fundamental factors. In this situation, technical analysis is ineffective, with traders focusing exclusively on US bonds. There is a theory that the ruble was weakened deliberately to offer cheaper Russian goods exports to countries with which Russia had recently signed new agreements. These are mainly African, Asian and Arab nations. So far, all these factors have had a negative impact on the stock index, which is steadily moving towards the 3,000 mark. Moreover, it may well fall below this level with no pullbacks. Perhaps the situation will change only upon reaching the $2,900 mark. And that's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.